Okay, perfect. So let's start with portfolio management. So the key learning outcomes, okay, describing the characteristics of the major asset classes. We will look at what the major asset classes are. We'll try to look at risk, aversion, and the implications. So basically, what do you answer by risk, returns, implications, so on. How do you select an optimal portfolio? Okay, and we look at concepts of utility and risk aversion, right? Capital allocation line. And very importantly, we look at what are the means, variances, and covariance. Okay, so we look at computation of mean covariance for a portfolio and look at two asset portfolio. And obviously, most importantly, what is the portfolio standard deviation? You guys know that standard deviation equates to risk, right? So what is the risk of a portfolio and how do you connect the two? So again, then the impact on the portfolio selection. Clear? So very important chapter from a risk return point of view and to look at concepts around that. Now, if you look at asset classes, right, over the many years, look at the example before you, large stocks, small stocks, corporate bonds. Now, what do you think? Who would give the most returns? The large stocks or the small stocks? Which type of stocks would give the highest returns? Answer, highest returns. What do you think? तो पानी नहीं ये चाय है क्या?
Now,
मैं नीचे से मंगा बनाएगा बनाएगा done. Thanks. Perfect.
you are strong in your life.
Strong.
You are done.
1.5. No, perfect. Thanks. So if you look at stocks, right? Now, large stocks, small stocks are types of stocks. The returns normally would be more consistent and steady for the large stocks, right or wrong? Right? And the smaller stocks, you do realize the risk is going to be greater, right? But same time, the returns also would be more variable. Clear? You know this, right? Let's say today in India, you invest in a Reliance. You will probably get a steady return. But if you invest in, let's say, a smaller stock, you might get a negative return 1 year, a very high return another year, and so on and so forth. So the returns tends to be different for each type of stock. So if you look at this table, right, large stocks, small stocks, you'll notice in the 1930s when the Great Depression happened, the risk of the small stocks was very, very, very high, obviously, right? But the larger stocks had a lesser risk than the small stocks. Now see, notice along the way what happened. 14, 13, 17, 19, 15, the risk has been more or less consistent. But look at small stocks. The risk was 70, 30, 20, again 30. It has gone up, gone down. Okay, gone up, gone down. The risk is so variant. Look at the volatility here. The risk is very, very high. Agreed? And here the risk is very steady. You know what I mean, right? So this is important. The risk for the large stocks would normally be more steady than the small stocks. But what is more important to understand here is the return also would follow the risk pattern. That means the return would be as inconsistent but extreme as the risk. Now look at the returns for large stocks. 9, it went up to 19, fell to 7, little bit 5, again 17, 18. It went to -1 because that was the Great Depression when the crisis happened, right? 13. But look at the small stocks. 20, 16, 15, fell to 11, 15. Look at how it has been hovering around the 20, 16 range. Why is the return higher? Because the risk is much higher. So the returns for small stocks was higher, but it was also low when it was effected. So you notice the small stocks tends to give you a slightly higher return and edge. Look at 2000, -1, but here it was 6.3. It's a little higher edge, right? Here it is 10, but it's 12. Here it is 7, here it is 18, right? Here it is a little lower in that year, right? But here it is 5, it is 11. So you'll notice it is outbeaten at some stages, most of stages, but some years it is performing lesser. Why? Because the small stocks has a higher risk and therefore potentially a higher return. Now, you know that corporate bonds are bonds issued by company. It will be much, much lesser risk because they might be secured. They are corporate issued by companies and they're bonds. So they have a fixed rate, right or wrong? So if they have a fixed rate, they'll also have a low return. Look at the returns. 5, 4, 8, 14. The risk is so much and the returns are very low but very consistent. 7, 6, 8. Do you see the difference? This is because the risk and returns are both low. Clear? Government bonds, even lesser because they're secured by the treasury. Look at the risk, 5, 2, 4, 6, very small. Look at returns. Returns also are very negligible, around 5 to 6, but they are low. Correct? Obviously, treasury bills, even better because these are secured by the government of the country, US government. So you see the risk is almost 0.2, 0.1, no risk at all. When will the government fail? So risk is hardly in points and the returns also are small. Clear? And inflation. So what do you understand by this? Asset classes have their own risk and returns. And in the world of CFA, as a portfolio manager, you need to ensure that you mix your portfolio with different asset classes. You cannot just go and invest all in shares. No, your client will probably, sink. You need to ensure some of your clients' money in large stocks, some in small stocks, some in corporate bonds, some in treasury bonds, some in T-bills, some in real estate, some in alternative. You have to play a diversified portfolio by learning risk and returns. Clear? So this part of the lecture is all about understanding what is the meaning of diversification. How do you deal with risk and returns at a portfolio level? Clear? Obviously, this is the real numbers of returns and risk premiums in US, okay, where equities had an average return geometrically 6.5, 8.4 arithmetically. The bonds which are safer gave only 2.5, which means the premium, the excess that the bonds gave equity gave over bonds was 6.5%. This is the premium that was earned. Premium. Why was the premium earned? Because the equities had a higher risk. Standard deviation means risk. Because equity risk was greater, the equity returns were greater. The premium given by equity was 6.5%, which was only because the risk was almost 10% higher. Clear? So this will help you understand that broadly, the higher the risk, the greater the returns that you can expect. Any questions? Yeah, guys? Okay. To give you a better idea of how the world assets were this is the US in the world, you'll notice similar structure. Equities obviously always give you a higher return, but don't forget the risks are also greater. So in case there's a downturn or recession or a depression or crisis, it will always be equity being impacted. Great. Look at the premium you're getting for equity. Why? Because the standard deviation was greater. Clear? The risk is much higher. All right. Look at the world assets. This is world including US. If you exclude US, look at the returns. Similar numbers. 6.2 premium is high, and therefore the deviation premium is here only 14%. What you also will notice is as the deviation premium is reducing, the return premium also reduces. Yeah, thank you. Huh? क्या? Interesting. Good? Super. Yeah, nice. Okay, and this is very important. The risk premium, the risk premium is greater. Huh? Okay, are we clear with this? Now, let me teach you how to compute this. This is more important. Okay, now obviously there are certain words which we'll come to in the course of lecture, like skewness, kurtosis, liquidity. Okay, basically trying to find out how related they are and what's the correlation among these assets. Okay, price impact. We'll come to these features in the course of lecture. What is risk aversion? Risk aversion. Basically, the word aversion means what? It means the dislike to risk. Aversion means I don't like it. यार मुझे पसंद नहीं इतना risk लेना. That is called aversion. ठीक है? So when I say the person is risk averse, it means that he does not want to take a risk. So and the opposite of that is a risk seeker, who's a person who prefers to take a risk. Okay. Now between the two is called risk neutral. Okay. Risk neutral is a person who's indifferent. आया तो आया, नहीं आया तो नहीं आया. So I have a risk averse who does not like risk seeker who loves risk, and risk neutral who's indifferent. ठीक है? So let's look at a gamble. Let's say you guys must have been to a casino. You do roulette, right? Or even that heads or tails, or even blackjack, right? All of those have a certain probability, right? And you know that if you go to a casino to roulette game, right? Getting a number has a probability of 1 by 36. Now, who will play that game? A person who loves risk. Be like, boss, for 100 rupees, I'll get 3,600 rupees. But the risk is also very high. But on the other hand, if you bet on the black or white, black or red, you will get for 100, you get 200. Kaun karega? One who's not wanting a risk. So, but you remember the payment also is lesser because the risk is less. I hope you can connect the dots to the casino. I don't know how many of you will have seen it or been there. But this is a very good example to understand that the person who takes a risk will potentially earn a greater reward, right? Now, let's look at alternatives here. Suppose I tell you that if you toss a coin, if a heads comes, you'll get $2. If a tail comes, you'll get nothing. What are the expected payoff? How much you may earn? Really good. Right? Now, understand one thing. Now, can you tell me how did I get this answer as $1? Can you tell me how I got $1 as expected payoff? Anyone? Go on. I can't hear you. Sorry.
Because I had spent $1. So.
No. So again, I'm repeating. You went to a casino. They said, I'll toss a coin. If a head comes, you'll get $2. If a tail comes, you'll get nothing.
Sir, it's 2 times 0.5 plus 0 times 0.5.
Well done. So you agree that there's a 50% chance that a head will come and I will get $2. But there's also 50% chance that tail will come, I'll get thenga. Nothing, right? Which means the expected payoff is 0.5 into 2, which is $1, and 0.5 into 0, which is 0, and the answer is $1. Understood? This is exactly how the casino rips you off. Casinos also play the same game. They'll charge you a certain amount and they'll pay you the probability. Example, if you go to a casino for roulette, they'll charge 100. But if you get a number, why do you think you get 3,600 back? Because the probability of getting a number between 1 and 36 is 1 by 36. So for 1 rupee, you'll get 36 times the amount. But you also realize that it will take you 36 chances in the statistical world to get the number. I hope you guys understood this. This is statistics, and this is very intelligent statistics, and this is exactly what you use in the world of expected payoff. Is that clear? Yeah. Okay. Are we clear? So, and I told you this, if you remember 2 lectures back, when I use the word expected, you always have to multiply probability with the number. I think I told you this in some lectures last week, the week before, right? Expected or, average or probabilistic, right? So here, you rightly pointed out it's 0.5 to 0.5. So therefore, I can also say that I will receive $1 with certainty or obviously 0 for risk averse. Now, person risk averse will say, boss, मुझे $1 दे दे, I'm खुश. A person who loves risk will say, boss, मुझे $2 मिलने का chance है. And a person who is risk neutral will say, boss, ठीक है, 0 मिला तो नहीं मिला, 2 मिला तो मिला, 1 मिला तो मिला. Clear? So understand the 3 categories: risk neutral, risk seeker, and risk averse. Clear? Any questions? Okay, now you guys tell me. Now I want you to answer this question. This guy is risk averse. Which of these options will he choose? Take your time. Which of these options will he choose?
Yeah. Okay.
Answer. Answer, guys.
Yeah. Yeah.
So we choose relatively safe investments.
Good. So the answer, sorry, I was just trying to see the other options. The answer, I might say clicked it as B, right? Now, he is risk averse, which means that he will want to avoid risk, right? Right? He's not liking risk. So he may hold some very risky investments. We said most likely correct, right? So therefore, he may hold some likely investments, but will he always choose safe investments? Not necessary. He is risk averse, but he will also hold risky investments, right? Any doubts on this? Anyone else? Any other questions? Now understand, risk averse does not mean that his tolerance is low. It only means यार वो risk को थोड़ा avoid करने की try करता है. ठीक है? So he'll mix and match. ठीक है? Very good. Okay. Now let's go to this. Now utility क्या है? Utility. The concept of utility is basically where I am able to check my satisfaction, right? Now utility मतलब खुशी, effectively satisfaction. Utility increases the higher expected return. If you get a higher return, then you'll get a high utility, right? Now, if A is the coefficient of risk aversion, matlab, if A stands for risk aversion, if it is more than 0, that means you're risk averse. If it's equal to 0, that means you're like, farak nahi padta. If it's less than 0, that means you love risk. It is called risk seeker, and the word sometimes called risk lover. So agar to risk pasand hai. Okay. Now US large stocks utility normally has a value which is 0.102 minus 0.5 into A, which is aversion, into 0.198 square. Don't know this formula, but just shows the trade-off between the risk and the expected return. Okay. Now do understand, if you have a greater aversion, you will also have a greater expected return. Clear? A greater aversion will also be occurring a greater expected. That means, agar तुझे risk पसंद नहीं है, if you don't like risk, then you might only invest if you have a correspondingly higher return. Why? Because you don't like risk. So to take risk, you better be compensated by a higher return. So a person, let's say, who doesn't like risk, he goes to casino, he will not sit and play a roulette game because he doesn't like risk. And if he's taking up that game, he will prefer that he gets extra compensation. That's why if you think of it, everyone who goes there will play the game of roulette because the risk return is much higher, right? Abhi, everyone knows that the risk is high because 1 by 36. Therefore, they're giving a higher return, which is 36 times. And therefore, the casino always wins, right? I hope you know the concept because they are trying to also satisfy the risk averse person, the risk neutral person, and obviously the risk seeker. Clear? So I hope you're clear with the concepts, right? So this is what the risk aversion utility function would be. They'll give the formula, normally utility formula 0.12 minus 0.5. If you look at this, the utility based on aversion and utility will work out like this. Okay. Expected return is 12%, 15%, 21, 24%. If the standard deviation is 30, 35, 40, 45, what will be the utility? Now remember, aversion is 2, right? So what would be the utility function? What's the formula? 0.102 minus 0.5 into A into 0.19 square. Okay, see this. Expected return minus 0.5 into the aversion into the variance. I'll call it deviation, standard deviation. Remember, guys, this will be squared because standard deviation is the risk, but variance is the square of the standard deviation. Okay, and obviously expected return is 12. Now remember, these figures are percentages, right? So you'll need to take 0.3, okay, 0.35, and this will be 0.12. Okay, now if A is equal to 2, right? I'm just trying to see, yeah. I think they've given you this example once. This example is for situation 1. So 0.12 minus 0.5, which is a formula, into 2, which is a utility, into 0.3 square. So this is the utility for 1. Similarly, find out for 2, 3, and 4. You'll get the answers, and based on that, you can find out the utility, whose utility is greater. Clear? Quickly solve that, guys. Tell me what's the answer.
Yeah.
0.5.
One.
2, okay. So see this, first one will be 0.12 minus, you have to do 0.5 into 2, which is 1, 1 into 0.3 square, which is 0.09. Correct, yeah. Solve it, guys. So first answer, utility is 0.03. Why? Is 0.12 minus 0.09. The second, that is 0.03. The second answer is 0.15 minus 0.5 into 2 into 0.35 square. है ना? Yeah. What's the highest answer?
0.0275.
Well done. Very good. Third answer. 0.21 minus 0.5 into 2, which is 1, into 0.4 square, which is 0.16. So 0.21 minus 0.16. कितना हुआ? 21 minus 16. 5. So that's 0.05. Yeah. Did you get that, guys? And the fourth one. What's the third answer? 0.05. Fourth one. 0.24. Fourth wala. 0.24 minus. Okay. 0.5 into 2, which is 1 again, into 45 square, which is 0.45 into 0.45. कितना हो गया?
0.0375.
Good. Very good. 0.0374. That's right. Good. Excellent. Now, obviously, they won't ask you all four, but remember, the utility curve function gives you the answers based on this formula. And you'll notice the answer, which is the highest utility, is this one. Did everyone get that answer? 0.05. 16 पे रखा है AC यार, ठंडी है. मुझे भी. Fish. Yeah. Is that clear? So what's the answer? This. So this is only to make you understand what is the utility, right? Where based on the risk, return and aversion, you can find out which investment is worth investing in. Clear? Now remember here, the most important thing is the risk aversion. Obviously, the answer can become different if I'm choosing a person who has a lower aversion, right? Because you realize this is aversion. अगर aversion बढ़ा तो the utility will be lesser. Aversion कम हुआ तो utility will be greater. Correct? So the answer will not be the same for every. In a person with an aversion of 2 will write 3. Investment number 3 is the right answer. But जिसका aversion शायद 2.5 है, he might like investment number 4. और जिसका aversion शायद 1 है, he may like investment number 2. Correct? So you have to look at the aversion factor. Clear? So what's the formula, guys? Learn this formula. It is ER minus 0.5 aversion variance. ER minus 0.5 aversion variance. Simple. Okay? It could be possible that the answer comes to negative. Negative obviously is a straight discard. Okay? Because return is not in matching your risk. Clear? Okay? Now, if you look at this, this is a bit of economics, right? You do know that risk and return is always going to be going hand in hand, right? If this is my x and y axis, ये मेरा risk है, ये मेरा return है. When my risk is increasing, I will want more return, right? So therefore, you'll notice that higher the risk, higher the return. Higher the risk, higher the return. Obviously, which means that as you go on the x-axis and increase the risk, you will have a greater demand for return. Therefore, the risk-return curve will be something like this, right? It'll probably go something like this. Okay. Now, what is this trying to show is that what is the various indifference curves of various investor. Let's say you're investor A. Investor A will say, ठीक है, मुझे ये risk पे इतना return चाहिए, ये risk पे इतना चाहिए, ये risk पे इतना चाहिए, or this risk I'll want. So he's showing you various points which show you one indifference curve, right? And same way investor B. Now investor B is saying, bhai, for this risk now I want so much return. Now you tell me, I have investor B here, and this is investor A, this is investor A, this is investor B. Okay, investor A is asking for so much return at this risk, right? Only so much return. But investor B is asking for so much return. Who is more risk averse? Investor A or investor B?
B.
Who is more risk averse? From this diagram. I have return here, I have risk here. Now again, look at the profile. Investor A is stuck on this side of the risk. वो सिर्फ इतना ही risk ले पा रहा है. Investor B is stuck on this side. वो ज़्यादा risk ले रहा है. Understood? So investor B is able to take more risk compared to investor A जो इतना ही risk ले रहा है. So therefore, investor A becomes more risk averse, but investor B is expecting a higher return. Understood? So there's a very tricky point, okay, which is important to understand that potentially if investor A is here and investor B is here, okay, this is A and this is B, A is stuck with less risk and therefore is more risk averse. B is happy to take more risk, but also wants more return. Clear? Now, obviously, this is the understanding. Therefore, A will go for less risk and less return, and B will go for more risk and more return. Clear? So this is how to understand the gap. Now, obviously, this further is important because this will help you understand what is the optimal portfolio. And the answer is, it is the line of tangency of the risk-free asset. So when I draw the capital allocation line, right, the point at which it is tangent to the indifference curve, that point is called the optimal portfolio. Clear? Because that is where indifference curve falls on. Clear, guys? Okay. So are we clear concept of risk averse, who's more risk and so on? Is that clear or not? Okay. Chalo. Let's start with an interesting, easy example.
So just one
Sorry, go on.
question.
Yeah. Yeah.
So in the graph, if the curve is steeper, it means they are more risk averse, right?
If the curve is steeper. When you say steeper, you mean more vertical, right? Not sleeping. Correct?
Yep.
Yeah.
Yep.
Yeah. So why? Yeah, that's correct. And why? Because if the curve is steeper, okay, if the curve is steeper, it means that this burger, for taking so much more risk, right, only little bit more risk, is wanting so much more return. So he's scared, he's risk averse. But if it's more flat, he's okay to take little more risk because he's not demanding too much more return. So that's right. I'm explaining to you why. Steeper indifference curve will always be a more risk averse person. Clear? That's right. You got the reason for that?
Yeah. Okay, sir.
Okay. Steeper is more risk averse, flatter is less risk averse. Okay. Brilliant. Now, okay. Any other question on this curve? So please learn every This is a very interesting graph. A lot of concepts are taught on this one page itself, but we're trying to get you to understand portfolio management related stuff on how the indifference curve works. Now, a very easy sum. I want to solve it. What is the mean return? What is the arithmetic return of asset A and asset B? Start. Average, very simple. Average क्या होता है? Add all the three numbers, divide by 3. है ना? So if I have asset A and asset B, what is asset A ka average? Mean return of asset A. 11 plus 4 of Z minus 3. 11, 4 minus 3, how much is that? Okay, so what's the answer, guys? A return is average 4%, 11 plus 4 minus 3, and B ka average is 6%. Simple. Now this is simple arithmetic mean. Clear? This is not rocket science, fairly straightforward. Just to make you understand, if I want to find the arithmetic mean, I need to look at the total of this. Any question with this one? This is fairly easy for everyone. Right? Now we'll come to the important concept of variance. Variance. Now, variance and standard deviation, right, are basically risk. Oh, should I just? Does anyone know what's the meaning of variance? Can someone compute for me? What is the variance? Wait, what is the variance one in this example? Okay. No. What is the variance of asset A? What's the variance of asset A? Anyone knows, or I'll start the sum the other way around. Perfect.
So it's minus mu from
Sorry?
it's minus mu from it's minus
No.
x the whole summation.
Sorry, no, I can't hear you. What are you saying? I can't hear clearly.
So the summation of x bar x minus x bar the whole square upon n formula.
Brilliant. Very good. Very good. Sure. Okay, very good. Now let me quickly tell you variance the meaning. Okay, I'll just come to it before I take the sum. Variance means what is the difference between average. See, now you all know key asset A from the earlier example was giving me an average return of 4%. Right? Sabko pata hai. Now, variance is nothing but how much is it digressing from the average. या तो एक साल 4% दिया, right? But एक साल तूने मुझे 11% दिया. Second year you gave 4%, but third you gave minus 3%. मतलब you have given me 1 year 7% extra. Second year you give me nothing extra. And third year you again give me 7% less. That means you get 7 more, 0 and 7 less. Overall, my variance is around 14%. But if I add all of them, answer will be 0. So what statistician said is, एक काम करते हैं, minus sign को निकाल देते हैं. But you can't just remove minus sign, right? So the answer was smart. They said, let us not remove the minus sign. Let us square it. Because by squaring it, the minus sign will go away. So therefore, they said, let us take 7 square plus 0 square plus 7 square. Okay? Obviously, don't forget, is the sum of 3 numbers. तो उसको divide by 3 तो करना ही है. Correct? And with that, I'll get obviously 49 plus 49 is 98 upon 3. Okay? 100 maybe. Around 33. And then don't forget, because you squared it. Now this square is normally called the variance. Okay? But if I want the standard deviation, all I need to do is take the square root. Why? Because I squared the numbers. So अगर मैंने square किया तो square root भी तो करना पड़ेगा. तो square root को standard deviation बोलते हैं. So in life, remember, when you square the differences, it is called variance. When you square root it, it's called deviation. Right? So that girl rightly said, variance is the sum of the deviations from the mean divided by the average, or uska square root will give you deviation. Simple. Clear? Now, if I tell you to find out sample variance or sample deviation, then instead of n, you will do n minus 1. Because जब भी sample use करते हैं तो हम n को -1 निकाल देते हैं, we'll get the answer. Is that clear? So understand, variance and standard deviation is based on n, and sample है, so it's based on n minus 1. Clear? Let's look at the solution now. Look here. Now they did n minus 1 because they took sample, right? So you see 7 square, 0, 7 square. Came to 98, 98 upon sample nikala, 49. Variance came to 49. So therefore standard deviation is 7, which you can see is very obvious that is the difference between the average. Same way यहाँ पे. Average 6 square, the deviation 64. You'll notice that the deviation is greater in asset B, and therefore the variation is greater. Therefore, can I conclude that asset B is more risky because uska standard deviation ज़्यादा है. Got it? Perfect. Clear? Clear? Any question on variance? Any question, guys, on variances?
For me.
Any question on that? So variation. So you learn two things: arithmetic mean and variance. Okay? And also standard deviation. Now let's look at covariance. Okay? Now covariance as a concept is nothing but the extent to which the two assets are correlated to each other. Okay, usko बोलते हैं covariance. Now what is covariance? Simple funda. When asset A, now basically it means that what is the difference of asset A and asset B? That means asset A is giving you more amount. That time what is B giving you? More or less? When asset B, A gives you less, is B giving you more? मतलब अगर A का return ज़्यादा है, तो तभी B का return कम है कि ज़्यादा है? Are they moving together or are they moving in opposite direction? Now, if you think of it, let's say कल market crash हो गया या price गिर गया, तो तुम्हारा पूरा portfolio गिर जाएगा, right? You don't want that happening. You want to keep some assets which will go up, some assets which will go down, because by doing that, you are protected against extreme falls. Imagine if all your assets are together and full market goes down, your full portfolio will be dragged down and you'll suffer a huge loss. But if you keep one asset which is not related to the other asset, then when this goes up, this will go down. Example, gold and silver. If the share price is going down, then you'll notice the gold prices are going up. Why? Because gold is a safer haven and the shares are negatively correlated to shares to gold. because they are different currencies, right? So you would prefer to invest in both because you're getting a diversification benefit. तो इसको बोलते हैं correlation or covariance, right? Now, how do you compute the formula? Simple. Find out what is the deviation from the mean for asset A and same time what is deviation for asset B. तो जब asset A 4% ज्यादा दे रहा है तो B भी 4% ज्यादा दे रहा है कि 3% ज्यादा दे रहा है या नेगेटिव दे रहा है. Take the average of that. Take the average of that and divide by n. You will get covariance. Khatam. That's it. So suppose here I'm getting 7% more. But here how much am I getting? Nothing, because average is same. Here I'm getting nothing, but here I'm getting 8% less. Here I'm getting 7% less, but here I'm getting 8% more. Now notice what's happening here. These stocks are actually negatively correlated. When A is giving you more, B gives you nothing. When A gives you nothing, B gives you less. And when A gives you less, B gives you more. So you notice that they are working against each other. And if I want to tell you what is the value of the covariance, simple. There's a formula for it. Simply do summary of x minus x bar, y minus bar, n. Now look at the sum. X minus x bar, y minus y bar, x minus x bar, y minus y bar, which I just explained to you. वो total को मैंने divide by n minus 1 किया, answer comes to minus 28, which means covariance is minus 28. Now it is good to have minus as an answer. It's good. Why? Minus means एक ऊपर एक नीचे, you are protected. अगर दोनों ऊपर गया सही है, but if both go down, finished. So therefore, when you make a portfolio, guys, remember as a CFA, always remember this mantra in life. As an investor or as a analyst for other people, always ensure that you are potentially diversified by using the leverage of negative correlation. Clear? Now let me show you one more thing here. You guys know the answer is minus 20. Like minus 20, chalo, very good. But how good is it? Minus 28. It could be minus 40, minus 100, minus 200 pakro. Arey, but what is the meaning of that? Is it strong or is it weak? If minus 28 is weak, then what is minus 100? It may be still weak, because if the actual number is 1000, then minus 28 could be very small. But what is the actual number is 30? Then 28 is strong also. So now, to help you with this, the strategist said, chalo, we'll solve the problem. Let us give you a covariance which will help you understand the strength of the correlation. So if you want to know कि minus 28 is weak or strong, या minus 100 is weak or strong, या minus 10,000 is weak or strong, no one will know that. So there's one way to find out. And that way is find out what is correlation. When you find out correlation using covariance, you will get an answer which will be between minus 1 plus 1. Okay, now this is very important. Understand this carefully now. Before I go to computing, what is correlation? Correlation is a formula which I'll teach you later. It's covariance divided by something. Correlation is an answer that will never exceed plus 1 or minus 1. ये दोनों के बीच में रहेगा. So suppose I'm looking at minus 1 plus 1 and correlation, like I told you, will never exceed this range if the correlation is somewhere in the middle. That means 0.1, 0.2. That means हल्का फुल्का light है. अगर correlation 0.9 है, मतलब strong है. अगर correlation minus 0.8 है, मतलब it is strong but negative strong. So if the correlation is somewhere around here or here, it means strong. If the correlation is 0.2, 0.3, 0.4, it is weak. And this is how to interpret correlation. Samjha? Is that clear? Because minus 28 is useless because you don't know whether it's weak or strong. But if I tell you it's minus 0.8, 9, you'll say, 0.9, yeah, it's very strong. Got it? And obviously minus plus is just a factor of, is it directly or directly? Are we clear? How do you find the magic number? How to find correlation? Simple. All you need to do is take the covariance and divide it by the product of the standard deviation. So what's the formula? Covariance upon standard deviation A into standard deviation B will give you correlation of A and B. Clear? Very important. Please learn this formula. This formula is for computing. Now, the beauty of this is this formula will never give you a value that exceeds +1 -1. ये आंसर हमेशा +1 -1 के बीच में ही रहेगा. Solve it, guys. Come on. Solve it. It'll give you an idea of what is the correlation. What's the answer?
-0.5. So you're muted.
Oh, sorry. So I'm saying do minus 0.0028 divided by 0.07 into 0.08. What's the answer?
-0.5.
Well done. Now, minus 0.5. Okay? Minus 0.5. Tell me. Now gives you two things. It tells you that the correlation is negative. That means एक ऊपर गया तो दूसरा नीचे जाएगा. 0.5. The 0.5 word tells you that correlation is in the middle. Matlab it's not too weak, it's not, because I told you it is between -1 +1. So it's 0.5. Now, what do you think? Is it weak or is it strong? So let me show the solution to you. Yeah. Now, 0.5 is somewhere semi-strong because between -1 and +1, so 0 is here, so it's somewhere here, which is mainly it's getting stronger, right? But this also means one thing, it's very important. It means that if A goes up by 10%, what will be the impact of B? Can you answer? B will go up or B will go down? What will be the answer? B will go up or go down?
It will go down, right, sir?
Well done. And B will go down by how much?
5%.
Well done. Excellent. So this is important. क्योंकि minus है, B goes down. Because 0.5, it means it'll go down by half of 10. If it was 0.6, then you'll say B will go down by 6%. And so on. Now, what is the beauty of this? If A actually goes down by 10%, your B will go up by 6%, which means you have not lost 10, but you have lost only 4%. So you need to have something that will protect you against the fall. Clear? Well done. Okay. So I hope you realize by now that in the world of investment and CFA, you better have a portfolio that is negatively correlated so that you are diversified. But don't ever go for completely negative because then you'll make no money. एक ऊपर 10 दूसरा नीचे 10 तो zero ही कमाएगा तू, right? So you don't have any risk. You want to have some risk and some return, which is very important. Again, depends on risk averse. If you are not risk averse, if you're a risk seeker, then you'll probably go for more risk. But I'm not saying that every time more risk gives more returns, but more risk is potentially going to give you higher expected return. Clear? Okay, now the last interesting concept is portfolio returns covariance. Okay, now before we do that, you all know what is portfolio returns, right? It's nothing, we just compute a formula. So what is portfolio returns? Expected return on portfolio, it is weight of asset A into return on asset A plus weight of asset B into return on asset B, correct? You know this? I taught you expected return formula. So suppose A and B are their two assets, and A is giving me 20% return and B gives me 15% return. What is your average return? Now you can't say it's half because you have to also find out कि भाई what is the amount I invest in A and B. अगर A में मैंने 80% डाल दिया and B में only 20%, I'm more likely to get approximately 20% return, right? And see the maths. 20 into 80 is 16% and 15 to 2 is 3%. So my weighted average is 19%. But had I done ulta, मैंने ये 20 और ये 80 किया, so my answer would have been close to 15%. Right or wrong? It would be 14. So 19 is because you did more in A, and 14 would be more when you come more in B. So weighted return is easy. It is weight into return, weighted return. Now, everyone knows this part now. Now let's come to a more interesting part. What is the formula to find out standard deviation of a portfolio? Okay. Now learn this carefully. It is, let's learn it like this. You know this formula, A square plus B square plus 2AB. Right? You know this. Simple. Remember this formula. You will always now you have to learn this formula. The calculator will not help you. Okay? What's the formula? A square. A square is nothing but this. So weight into deviation square. Weight into deviation square. But weight A, weight B. Correct? Weight A, weight B. Now, what is 2AB? 2. Weight deviation A. Weight deviation B. But one thing you have to add here is correlation. Okay? That's your formula. खत्म. और मैं square root क्यों किया? क्योंकि मैंने square किया. So weight deviation square 2. Weight deviation. But add the correlation. खत्म. Now you do realize कि if I do correlation into deviation, I will get covariance, right? You know the formula of correlation is V. So you already know that correlation, which is known by this symbol, is covariance upon deviation. So correlation into deviation is equal to covariance. So I could also replace this part by this, which is why the shortcut formula is this. But don't learn this formula. Learn this formula because this formula is A square plus B square plus 2AB correlation. तुम लोग लाइफ में नहीं बोलोगे. A square, B square, 2AB correlation. AB is basically this and this and this. और ये तो मैंने फ्री में डाल दिया. Clear or not? Now the beauty. Now this is obviously based on the quotient. But if your correlation, ये जो है यहाँ पे, if it's exactly equal to 1, then this formula can be cut into a simple formula, A plus B the whole square, which is A plus B root. The deviation is equal to A plus B because the correlation is perfect positive 1. Are we clear? Okay, I can prove it to you. It's basically A square plus B square plus 2 into AB, which is A plus B the whole square, which is A plus B root. Correct? So please remember this. Agar correlation perfect positive 1 hai, answer will be weight deviation. If it's perfect positive negative 1, then this doesn't work. Huh? Please remember. Okay. Potentially. But then you can do A minus B. Okay, if it's perfect negative 1. Because A square minus 2AB plus B square is A minus B the whole square. So if it's minus 1, the formula will be weight A deviation A minus weight B deviation B. Right or wrong?
Right.
Correct? And this will help you to find the optimal weight. Okay, are we clear with this, guys? Okay, now we'll just do a quick sum and then take a break. But it's a very important sum. This will summarize all the knowledge of what I did with you in the last 1 hour. Okay, I'll give you 5 minutes. Take your time. Use a calculator. Let's assume this is A and this is B. Okay, I'm also telling you कि मैंने 80% इसमें invest किया, 20% इसमें. I want you to look at return, deviation, covariance between the two assets. This is covariance between A and B. Look at this and tell me what is the expected return. You know, expected means probabilistic. What is the portfolio variance? Portfolio ka variance. I'm giving covariance. And what is the standard deviation? Now, I hope you realize by now, standard deviation nothing but square root of variance. तो अगर ये आंसर आ गया, उसको रूट करो, डिविजन मिल गया. So tell me what is expected return and portfolio variance. Start. Okay, start, guys. Come on, 2 minutes I'll give you. It's not so difficult if you want to take your time, but please solve it because this cannot be done by using the CFA calculator. You have to do it by using the normal calculator. Start. Everyone, please compute. Once the answer is there, I will sit and compute the answer and give it to you. So what's the answer here? Expected return. Okay, it is the average. Now remember, guys, here you can't take simple average. You have to take weighted average, right? So look 0.8 into 9.93, 0.2 into 18.2, right? So the answer is around 8%, and this will be around 3.6. So I think the answer is around 11 point.
Yes.
Around 11.6%. Right or wrong?
Right.
Can you guys answer?
Yes, sir.
Yeah? You took the
11.5.
weighted average. Don't take the simple average. Okay? Okay, now take variance. Now variance is a little tricky. Remember, to do variance, you have to get covariance also. Now, what I suggest you guys should try and do, because I taught you the formula is a square plus b square plus 2ab. What you first do is find out correlation. Okay. Now, you know correlation how much? 0.05 is covariance divided by deviation, right? And deviation is 0.1621 into 0.3311, right? What is the answer? Covariance is decimal, right? Correlation is saying. Because, okay, this is one way. Now you know the formula. It is, the formula is weight square deviation square. Correct? A. Weight square deviation square B. ये तो तुम लोग को जानते हैं. You all know this, right? So you look 0.8 square into 16.21 square. Correct? Right? And then you do this. 0.2 square into 33.11 square. Correct? Now the real trick comes here. You'll do two weight, right? Weight A, weight B, deviation A, deviation B, correlation AB, right? Now this part of the equation is also equal to covariance, right? Right or wrong? So instead of solving this again, you could simply say, यार इसको मैं replace कर देता हूँ 0.005 से. So in the exam, if they give covariance, do shortcut, you won't have time. And this obviously is 2 into 0.8 into 0.2 into 0.005. So that's your relationship. This is your answer for variance. मैंने square root नहीं किया. मैंने बोला a square plus b square plus 2ab, but मैंने correlation घुसाया और उसमें covariance डाल दिया and I replaced the deviation. I hope that's clear for everyone. है ना? I hope this part is clear. So what answer you got for variance? Answer, guys?
17.1.
17 point?
1.
17.1. Okay, others?
8.2. 8.2.
What other people?
So 0.0228.
And there's one more thing. While you're looking at my answers, remember, so I just gave it to you, but when I take return, I'll take decimals, when I take percentage also. So here, I should do 0.16 and 0.33, okay? So do 0.8 square into 0.1621 square. Okay. Now, I'll teach you one more thing, okay, before we go it. On the CFA calculator, okay, if you want to do all this, how will the calculator use? Now, do you guys know how to do the store function I taught you that day?
Yes,
Right
sir.
or wrong? Right? So you guys should use the store function like this. Look here. Oh, you guys can't see the screen, no? So on your calculator, wait, huh? Let me share my screen and I'll show the calculator usage. Yeah, you can see the calculator. Answer.
Yes, sir.
Okay, now see what you'll do. Now, you know the formula is 0.8 square, है ना? 0.8 square, look here. Multiply by 0.1621 square. Right? Now, what is the answer? This is the answer, 0.02 जो भी है. I will store it in 1. Got it? Now, let me do the other sum, other part. 0.2 square, right? Multiply by 0.3311 square. कितना आया? Whatever. This answer will be stored in 2. ठीक है? Now don't say 00, there's something like 0.0042 something. मैंने सिर्फ 2 decimal लिया. I should make it actually 4 decimals. So look what I'm going to do. I'll do second dot and I'll write 4 decimals and I'll say enter set. मैंने set कर दिया 4. ठीक है? तभी 4 decimals में आएगा. Now let's do the third part of the equation. What is the third part? 2 multiplied by 0.2 into 0.8 into 0.005. कितना आया? 0.0016. Now, you need to multiply this number with the earlier number with the earlier number. So what you'll do, this number now do into, now recall 1 into recall 2 and you'll get the answer. Clear? Okay. Let me see why the other one is a 0.8 square into 0.1621 square. Yeah. This answers the first one. Then 0.2 square into 0.3311 square is equal to this. This will be stored in 2. And then I'll do 2 into 0.2 into 0.8 into 0.05 multiply by, I'm recalling the first function and multiply by recalling the second function. Into 100. Yeah. Can you see my answer screen? Yeah. This is the answer. So the variance when you do this should come to 0.0028. Okay, so look at the answer again, 0.8 square into 0.1621 square, 0.2 square into 0.311 square, plus 2 into 0.8 into 0.2 into 0.005. This answer should give you 0.022802. अभी उसका मैंने square root निकाला, तो answer will be 0.15 here. Now remember, this is nothing but the decimal. उसको मैंने 100 से n में multiply किया to find out the percentage, because variance is also in percentage and return is percentage. Are we now clear? So average return, everyone got 11.58. Variance is 0.02280, which is also 2.28 percentage. और उसका मैंने अगर square किया in decimals, I'll get 15.1 percentage. Clear? This is my standard deviation. Any questions? Okay, so on the calculator later, I'll also teach you how to do this using the CFA calculator for percentages. Okay, so same way you can do it for this also. I can do this and do in the break. But let's say XP return is what? Weight into return plus weight into return. Deviation is what? The same formula. A square plus B square plus 2AB. उसका रूट निकाला तो मुझे standard deviation आया. Clear? Okay, see the answers. 0.6 into 0.055, remember take decimals. 0.4 into 0.007. That's the average. Then A square, 60 and 13.2, right? B square, 40 and 4.2, 2AB. Okay, and don't forget, अभी यहाँ पे correlation दिया मैंने, correlation. So you have to do correlation into deviation. You can't leave it as just correlation. And remember, इसको मैं decimals में करता हूँ. So the answer came to 0.06. उसको मैंने square root किया, the answer will come to 8.1. Yeah? Okay, guys? Any questions? Are we clear? So I taught you concepts of return, expected return, standard deviation, variance, okay, how to find the weighted average and how to put the formulas. Any questions? Yeah. And this is how the matrix potentially looks like. Okay. So do remember, the stronger the correlation, right, the more diversified the assets will be. Example, if I see, let's say stock A and stock B, right? If stock A, let's say I put all my money in stock A, this will be my return. If I put all my money in stock, B, all my stock A, this is my return. But if I put some money in stock A and some in stock B, then the portfolio look like this, right? But if there is a correlation, now look at this. If there's a correlation of 0.3, it will go like this. If it's more negative, it will go like this. And if it's perfectly -1, it will go like this. Okay, this is because as the correlation is more negative, the risk return will be more diversified. You'll notice one thing, when it's -1, there is a point on the curve where return can be 0. It's possible to reduce your portfolio return to 0%. You can't make it 0 in any other situation. Even if it's 0.9, it'll go something like this. But if it's -1, you can take it to 0. Clear? So this is important to understand that as the correlation becomes stronger negative, it will reach a point where it can touch 0. This is how correlation and risk go hand in hand. Yeah. And that's why it's important that you have to add different stocks. Example, if someone has a new stock, जिसका deviation same है, but correlation coefficient 1 से कम है, which means he's adding to the diversification. You tell me, if I add something which is having a correlation less than 1, what effect will it have on the portfolio's risk standard deviation? If I add a stock having a correlation of less than 1, what will be the impact on the deviation on the risk of the stock portfolio? Will my portfolio risk go down, go up, or remain the same? Correlation is less than 1. Matlab, it is bringing down the impact of the loss or the profit. So what's the answer?
Medium.
Risk of the portfolio will go down or go up? Same तो हो ही नहीं सकता because there's a negative correlation. There's a less than 1 correlation. So what's the answer? Standard deviation of the portfolio. Answer, guys. Answer. So whenever correlation is less than 1, the stock's deviation will be decreasing, because if you remember the formula, it was always 2 into weight deviation into correlation. So correlation less than 1 है, मतलब 0.9 है, 0.8 है. This overall value will go down. Your total deviation variance of the portfolio will also go down. Got it? So less than 1 means portfolio ka deviation will go down, and that is called as portfolio diversification. So always add a stock which has a correlation of less than 1, best negative correlation. Clear? Okay. Okay. So we'll come to the next part, which is more economics, after a small break. Okay. So let's take a quick 15 minutes break. We'll come back to the last few, to next 20 slides on this, 25 slides. And please read a bit. Any doubts, let me know. Okay. Sure. The time is 5:38, 5:48. Let's reconvene at around 5:50, 5:50, 5:52. Okay. Okay, let's resume, guys. So portfolio diversification solution. Okay, so we stopped at this one where we said how to diversify portfolios. Right now, efficient frontier is a concept in economics where we learned about the frontier of all the best investments. Now, basically, if you look at it, expected return and expected risk from a portfolio, right? Now, you know that as you add more and more assets to the portfolio, your portfolio deviation will reduce, right? So let's say I invested all my assets in asset A. So मेरा risk इतना है और मेरा return इतना है, right? This is my return and risk. But if I add more assets which are giving me slightly higher return, then because of diversification, my deviation is reducing, but my return is going slightly up. So this is indicating that my risk is reducing, but my return is increasing. Why? Because I'm adding assets which are adding higher return and reducing my risk. This is because I told you, if your correlation is less than 1, so tera risk hamesha kam ho jayega. Now this will keep happening till a point where your risk is the minimum. Usko bolte hain global minimum variance portfolio, GMVP. Matlab, at that point, your overall variance is the lowest. सबसे lower. Because वो point के बाद तेरा portfolio variance will start going up. Okay. And why is going up? Because you're adding more and more of the riskier asset. Okay. And your return is so obviously increasing. Your return is going higher, but your risk also is going up. Clear? Okay, so this is called GMVP. And as you go higher, you will see. Now, learn this carefully. What is important to understand is this. After the GMVP, the combination of risk return of every asset, this line above the GMVP is called as the efficient frontier. So this is pretty much useless. I hope you understand, because यहाँ पे ये point है, this is bakwas compared to this point, because same risk, higher return. Obviously, you'll go for that point. Got it? This point is useless compared to this point. So what you understand is that every point on the efficient frontier is more efficient than every point on the below line. Got it? And this is why we deal with the efficient frontier and we discard this point of the equation. Clear? So I hope you understand the meaning of the efficient frontier. It is the points above the GMVP. 5301. Clear? So you got the definition of efficient frontier. It is all the combination of assets that lies above the GMVP. Log out, do log out. Okay? And that's why we say it's coming from expectations to correlation. RR. Clear, guys? Okay. So when you take an efficient frontier, it's all about getting the right mix. Now you guys tell me, how do we deal with this? Okay. So you tell which of these portfolios falls below the efficient frontier. Below. Can't compute it and tell me which falls below the efficient frontier.
All right.
So which asset, which portfolio falls below the efficient frontier? Answer. Can't try answering that. Efficient frontier ke niche, which one will lie? Without computing, this is just, oh shucks, sorry. This is just a bit of common sense, right? Which one you think lies below efficient frontier? Okay, now if I draw this is ER, this is deviation, right? When deviation is 14%, ER is 7, right? So let's say 7 is here, 9 is here, 12 is here, right? Deviation 14, let's say 22, 26. 26 and 12 lies here. Correct? Sorry, 22 and 12 lies. 26 and 9. 27, 9 lies here. And 14 and 7. 0. Which one would be lying below the efficient frontier? Mute. Okay. Now basically you have to look at which portfolio is giving you not the best return. This portfolio, the return is 0.5 per deviation. Enough. This portfolio return is almost 0.52 per deviation. Correct? But this portfolio is giving you 0.3 per deviation. है ना? So इसका return बहुत बेकार है compared to the risk. Right or wrong? So which is the worst portfolio here? Guys, whose risk is so high but the return is not so great? देख अभी ये देख, ये 14 दे रहा है 7, ये ज्यादा रिस्क है but ज्यादा रिटर्न दे रहा है. ये पोर्टफोलियो इससे भी ज्यादा रिस्क दे रहा है but उससे कम रिटर्न दे रहा है. समझा कि नहीं? B is worse than C, is taking more risk and giving you less return. That's not possible. More risk should give more return. Right or wrong? So therefore the answer is portfolio B, which is giving you lesser return for a higher risk. Clear? You answered B, right? The other girl was the answer.
No, I was actually asking how will we find the GMVP over here?
Acha. See, like I said, there's no need to find the GMVP here. You don't need to find the GMVP. All you need to see is which one is potentially giving a lower return at a high risk. Because you see, this is my frontier. Okay, matlab, now understand this. At every point on the frontier is superior to this point, which is the same risk. मतलब same risk पे मुझे ज्यादा रिटर्न मिल रहा है तो ये सुपीरियर है. बट यार ये पॉइंट ऐसा है जो रिस्क भी ज्यादा दे रहा है और रिटर्न भी कम दे रहा है. दैट्स नॉट पॉसिबल बिकॉज आई शुड ऑलवेज गेट अ हायर रिस्क एंड हायर रिटर्न. सो बी इज द ओनली थिंग which is giving me a low return at a high risk, and therefore it is lying below the efficient frontier. अभी फंडा समझा? जो तुझे लो रिटर्न दे रहा है सेम रिस्क या हाई रिस्क पे, वो है एफिशिएंट फ्रंटियर के नीचे.
Yes,
Got it? Very good. ठीक है? And you'll get that from here also. Same risk, low return, और higher risk, low return. ठीक है? ठीक है? So you don't have to find compute here, just work it out based on that. ठीक है? So it's portfolio number B. Clear? And this extends to the discussion around the optimal. So I wanted to connect the dots here and show you how the risky portfolio will be connected, right? So we already told you that if this is my frontier, right? How the frontier works like this and like this. Clear? Now now you'll say that this is how the efficient frontier goes. This is potentially my minimum variance, right? Correct? And this is the capital allocation line, which is under this. Okay, this one. You'll have various capital allocation lines. This one. Okay. Now, the line, the capital allocation line, which is tangent to the efficient frontier. Okay, tangent to the efficient frontier is called the optimal portfolio. Okay, so you need to find out which line is tangent to that capital asset line, allocation line. That will give you the optimal risky asset portfolio. Okay, now normally the optimal line, which in the market, because the market line with the market portfolio, it's also referred to as the capital market line. Clear? So capital allocation line, capital market line. Okay, you look at the optimal risky asset portfolio and connect the dots. Okay, so it goes like this. I may have one line going here, one line going here, but find the tangency point, and that gives you the optimal risky asset portfolio. Clear? Okay, this is again economics. You'll see the same concepts come in economics as well. Right? Now, when you think of it, what is risk? Risk is nothing but two things: systematic risk and unsystematic risk. Now, systematic risk means the risks that are existing within the systems. मतलब system के अंदर बैठा है risk. System के अंदर है. Right? And system means market. So when the risk is there within the system as a result of the market factors, macro, micro, and so on, this is called as मतलब जो भी हो, the market going up and down will give you the risk. So it is not linked to the company. It is not linked to the firm. It is linked to the market. So because market risk and market is system, I call it systematic risk. दूसरा है unsystematic risk, which means it is the company specific risk. Right? अगर तुमने कल, let's say you invest in a betting company like Betfair or Dream11, उसका risk अलग है because the company is doing bets. So that is firm specific or company specific unsystematic risk. Why it's called unsystematic? Because it's not related to the system. Got it? Now, you can diversify company specific risk by investing in another company which is not which is negatively correlated. You can diversify. So therefore, I will call it diversifiable risk. Firm risk or unsystematic risk can be diversified, but market risk cannot be diversified because market risk is always going to exist. So I will call this non-diversifiable risk. हमेशा रहेगा, diversify कर ही नहीं सकते. So because you are stuck with market risk which you can't diversify, you will be rewarded for taking up systematic risk. Because if the risk can be diversified, then you better go and diversify it, no? Why should I reward you? So if it's diversifiable, you need to diversify. If you cannot diversify it, then I will reward you. And therefore, we give it a value of beta, which is systematic risk, which I want to diversify. Are we clear? So basically, total risk is broken into two parts: systematic risk and unsystematic risk. Systematic risk is market risk, unsystematic risk is company risk. ये market risk है और ये company risk है. Are we clear? So quickly, tell me what is the answer here? The issuer specific component of the variability. That's was the answer. Okay. Very good. That is unrelated to market. मतलब company specific है, unsystematic. Because if it's market, it is systematic, and market is not diversifiable. This is unsystematic, and this is also diversified. Clear? Very good. Clear? So obviously, remember, you will be compensated for only taking up systematic risk. And therefore, you see in a portfolio, right? You'll see, sorry. In a portfolio, right? When you have the risk will always have some element of systematic risk, which is fixed, which is market risk. And the other part is the unsystematic risk, right? Obviously, now this is very interesting. As you add, let's say you invest only 2 stocks. तुमने सिर्फ 2 investments किया. The risk is very high. As you keep adding 3, 4, 5, 6, you add more and more stocks, your risk will come down. Why? Because your unsystematic risk, which is diversifiable, is being diversified, and eventually you will be left only with market risk. Samjha? And this is what you should be compensated, because if you're smart enough, you should have diversified all these risks and removed it out. Clear, guys? Okay. And this is the crux of portfolio diversification. Try to diversify in such a way that all your market risk is intact and only stock risk is remaining. Yeah. Okay. Now, guys, tell me, what is the answer here? Take it back. Is the example?
So increasing security reduces risk.
Which option? A, B, or C?
Okay. Total risk will fall at a decreasing rate by higher number of securities.
Others?
Me. Yeah. Okay.
So as you increase the securities, your risk will fall because your diversified risk is diversified, but it will fall at decreasing rate because initially you diversify more and more, but later the rate of diversification will reduce. Very good. Is the explanation? Okay, and therefore we have return generating models. Okay, now basically the market model says that when you're making returns on an asset I, right, you will make alpha fixed return plus you will make beta based on the market return. See, remember we said beta is a market systematic risk. So whatever the market is giving you, you will base it on the market risk, right? So system में जो return मिल रहा है, you'll get. So basically, the return you should get is always going to be the risk-free rate plus the risk premium. And what's the risk premium? Is the risk that you take in the market, which is systematic risk, into the market return. जितना ज्यादा मार्केट रिटर्न लिया तो मार्केट रिस्क लिया उतना ज्यादा रिटर्न मिलेगा. Clear? So this is the premise of the CAPM model, where we say, boss, I will earn so much for taking no risk because that's your risk-free rate. Plus, I will earn more and more risk. I will earn more and more return. So this is how it will go. Obviously, the slope is very important. The slope indicates the rate of return. If it's like this, it means I'm earning more return for little risk. If it's like this, I'm earning lesser return for more risk, right? So the slope is indicating the rate of return that you will essentially be earning. Clear? Got it? So slope refers to beta, right? And this is what you might say. So when you look at return models, you have to ensure you understand. So there are the various models. There's a pharma French 3-factor model where they say, let's look at the different factors that effectively will determine my returns, right? What are main factors? Firm size, the book to market ratio, and most importantly, what is the excess return that I'm able to make on the market portfolio, right? If you think of it, Carhart had also added one more factor called the momentum factor. Clear? So this is called the 3-factor model. Please remember the 3 factors: firm size, book to market ratio, and the excess return that you're going to add on the market portfolio. That means the difference between the market return and the risk-free rate of return. Okay. You can learn to estimate beta using the market models also. Okay, that's how they do it. So return, this is essentially an extension formula where I say return is a fixed return plus the beta into Rm. E is obviously the error term, which is going to be affected. Now, this is an important formula. We keep saying beta. Beta is what the rate. The rate. Now, beta can be connected to the correlation formula, right? Remember what correlation formula was? Covariance upon deviation A into deviation B, right? Now here A and B is basically itself. Therefore, market, it is deviation square of the market. So beta is equal to covariance upon market variance. Clear? Beta equals to covariance upon market variance. Remember, correlation formula is what? Covariance upon deviation to deviation, right? Same way, beta is covariance upon deviation square because here A and B is my market. Are we clear? So please learn the formula for beta. This is a very hot question sometimes comes. And obviously, if you want to find out कि portfolio का beta क्या है, it's simply the weighted average of the portfolio assets beta. So अगर मेरा 3 asset है और तीनों का beta अलग है, I can take the average by simply multiplying by the weight and I can get the weighted beta. Clear? This is how you find the weighted return also. So beta of a portfolio can be found out by that. This is the most important formula I mentioned to you earlier also, CAPM. So it is nothing but the risk-free rate that you want to earn plus the risk premium, which is nothing but the beta into RM minus RF, that's the excess return on the market. Market ने जो premium दिया, उसको मैं beta से multiply करूंगा to get the risk premium and also have the risk-free rate. Together, this will give me the expected return. Yeah. Obviously, there are certain assumptions for formula. One is that investors are risk averse, obviously, right? Because investors are not risk averse, then they will not have such equation. They have similar expectations, one period time model, infinite usable with assets, no inflation, and very important that investors are price takers. Clear? So ये formula please study करना. Look at an example of how you'll find the formula. So if I tell you compute what is expected return using CAPM, what's the answer going to be? Very simple.
Yeah.
Compute. Formula नहीं present.
Yeah. Niकाला, time निकाला.
Instead of compute what you earlier, put the variables, what's the expected return?
7.5%.
No. Wrong answer.
$0.0839.
Correct. You know this formula? Put the variables. Get the answer. Clear, everyone? Now let me teach you something interesting here. From an example, understand point of view. When the market return is 8%, and beta is 1.06, that means your beta is 1.06 times market return. Marker. तो मार्केट से ज्यादा रिस्की है बिकॉज ऑफ बीटा योर रिस्क सेंसिटिविटी इज ग्रेटर देन मार्केट रिस्क राइट और रॉन्ग because beta is 1.06 which means more than market risk, right? If I'll come one minute. Hello,
How are you?
good, 1 minute. So what is important to understand here is if the risk is greater than market, if the risk beta is more than 1, right? That means your expected return is going to be more than the market return. And how much more will it be? Depends on how much the beta is. If the beta was 1.5, then the answer would not be 8.3. It might have been 12 because market is 8%. But because only 1.06, you'll see the return is very close to market return. है ना? This is an important logic way to understand. अगर बीटा 1.2 के आसपास है मतलब तुझे मार्केट रिटर्न के आसपास मिलेगा. अगर बीटा 1 से कम है तो तुझे मार्केट रिटर्न से कम मिलेगा. Are you getting it? So please connect beta with market return. This is a very important logical understanding to do because sometimes in the exam, let's say the options are 8, 7.5 and 8.4. So you know the answer can't be 8 because beta is more than 1. Answer can't be less than 8. Answer has to be 8.4. So bina compute karke you could find the answer because it is more than 1. Clear? So beta is the determining factor for the average expected return. Are we clear? And beta normally should be more than 1 to beat the market. Okay? What is beta? It's the rate sensitivity of the rate of return to the market return.
So sorry,
And
could
from-
you explain the concept again? How you can
See, basically what is beta? It is the risk that you're taking with regard to the market risk. If you're taking the same risk as the market, you will get the same return as the market, right? If your risk is also 1, that means you'll potentially earn the market. Check if you want. If your beta was 1, answer would have been exactly equal to 8. Because you're taking the same risk as the market, because beta is the market risk. If you're taking a risk of 1.06, that's little bit more than the market risk, then you will earn more return than the market return risk. If your risk is less than the market, which means if your risk is, let's say 0.9, because market risk is normally 1, and you're at 0.9, which is less than market, then your return also will be less than the market return. I got it? So that's a connection.
Okay, sir. So next time, even without calculating, we can
Exactly. You can estimate. You can't get the correct answer, but you can gauge. Correct. That's what I explained to you. You can gauge. Now let's say beta is 2. So you know the answer is bound to be somewhere around 16-17%. You know that, right? So just to get a ballpark of how much, if you do the maths, 1.5 plus 2 into 6.5, right? That's 14.5%, around 15%, 2 times. Obviously, you can't still be 2 times 8. You can't still be 16%. It'll be because there's also a risk-free rate involved. Clear? So beta is helping you understand what is the extent of expected return I'll get vis-a-vis market return. Clear?
Okay, thanks, sir.
Yeah, welcome. Now, security market line is essentially a line that shows the CAPM formula. So, you know, CAPM is your earning risk free for sure. And jitna zyada risk lega, wo bhi beta, utna zyada return milega. More risk, more return. More risk, more return. So therefore, you'll notice that this line is depicting the fact that you will earn minimum RF. So, ne 0 beta liya to bhi, you will earn at least this much. And the more beta you take, the more RM you learn, which is why the formula is RF fixed plus beta, because as your beta increases, your risk premium also will increase, your R will increase. So this formula depicts how the SML line will work, and this formula is based on the CAPM model, capital asset pricing. Clear? Okay. Now, potentially the last part coming from here is ratios. You guys need to learn and remember 4 ratios. Okay. Very important, guys. This is very, very important part of the learning. In this topic, it also comes in equity also. You need to learn how to evaluate the performance of the portfolio by using ratios. Now, what are 4 ratios? Sharp, Treynor, M square, Jensens. Okay? Important that you study all the 4 formulas. Let's pick up one by one. What is a Sharp ratio? Okay? Sharp ratio. Sharp ratio essentially computes the extra return you are earning for the extra risk. अगर मैंने 5% ज्यादा रिटर्न रिस्क लिया तो मुझे कितना ज्यादा रिटर्न मिल रहा है? 10%, 12, 14. How much more return am I earning for every extra risk I take? This is called the Sharpe ratio. Example, let's say, now obviously it means how much extra return I'm earning in my portfolio compared to my risk-free return upon how much risk am I taking compared to my risk-free portfolio. Now you do know that risk-free matlab zero hai. So that means it's nothing but the excess return I am making over the risk which is excess. Abhi to jaake bank FD mein paisa kahan you learn 7%. But if you go and put your money in mutual funds, you learn 20%. But bank FD risk is zero, but mutual fund risk is maybe 1.5. So you are earning extra 13%, but taking a risk of 1.5. That's a Sharpe ratio. You are making 13% extra return on FD, on mutual funds, and for that you're taking a risk of 1.5. Sharpe ratio. Maybe if you put in stocks, you're earning 25% extra, 20% extra, but you're having a risk of maybe 2. So you can find out which investment gives me a better reward to risk ratio. So what is Sharpe ratio? Reward to risk. जितना ज़्यादा risk, उतना ज़्यादा reward. कौन सा investment मुझे सबसे ज़्यादा reward दे रहा है compared to the risk? Is that clear? Sharpe ratio. Are we clear this logic, guys? So in the exam, remember, it's nothing but the difference excess return over the risk-free rate divided by portfolio deviation. Clear? This is Sharpe ratio. Now, Treynor ratio also does the same thing. But what Treynor ratio does is, he says, yeah, you can't divide by deviation because I don't believe in deviation. I believe in beta. Deviation is what? Beta and unsystematic risk, right? And I also already told you unsystematic risk should not be rewarded. So Treynor बोलता है unsystematic को मार गोली, सिर्फ beta को ध्यान देना. I will give you a Treynor ratio which is the same formula as Sharpe, but I will divide by beta. So please learn in the exam, Sharpe and Treynor are the same thing. Both are using RP minus RF in the numerator, excess. But Sharpe is using deviation as a proxy and Treynor is using beta as a proxy. बस वही फर्क है. Are we clear? Okay. Now let's go on Jensens alpha. Jensens alpha simply say कि भाई जो CAPM model ने बोला, the return that the CAPM model should have given you, how much are you earning over and above that return? That is what Jensens alpha is doing. What is CAPM model? RF plus beta into RM minus RF. This return you should earn as per CAPM model. How much are you actually earning? This much. What's the difference? That's called Jensens alpha. Easy? Okay. So CAPM model का return लो, उसमें से actual return निकाल दो, you get the alpha. Alpha is nothing but a proxy for excess return. कितना ज़्यादा पैसा कमा रहा है उतना तेरा Jensens alpha हो जाएगा. Clear? Okay. This is beta adjusted portfolio. Clear? So you learned Sharpe ratio, Treynor ratio, and Jensens alpha. Clear? Sharpe ratio, Treynor ratio, and Jensens alpha. Clear? So in exam, hopefully these come. Please understand how to compute these three numbers. Okay. Now let's come to the last ratio, which is called M square. Okay. M square ratio, a little tricky, is basically saying, it's basically computing for you what is the risk-free rate, okay, plus the excess return on the portfolio vis-a-vis the risk-free rate. Okay, so this is nothing but the premium but it is multiplying that with the ratio of the market risk and the portfolio risk. Because don't forget, you're taking extra return because of extra risk. So it is simply computing what is the risk-free plus the premium into deviation upon deviation. So that is called the M-square ratio. That's nothing but the extra return that you're effectively making, okay, on the M-square model. This you'll have to learn a bit, but Sharp, Treynor, and Jensens alpha is more straightforward. Now let's hear you guys. Now this is a typical exam question. They'll tell you, this is my deviation, this is my beta, this is my return, and they'll give you RF obviously. Now they'll tell me which portfolio manager is better. Okay. Which manager, obviously, actually, is the manager better or is the market better? You need to compute for me what is the expected return and what is the Treynor ratio and the Jensens alpha for both these products. Okay, so let's start. This is a very important summary. Let's start one by one. Compute for me first the expected return, then compute the Treynor ratio, then the Sharp ratio, and then the Jensens alpha. We'll do M-square later in the end together. Okay, let's start. Let's do one by one. So I'll give you guys 5 minutes. Take a pen, paper, look at the sum, and try to compute all the numbers one by one. Okay, then we'll debrief the solution together. Okay, start, guys. Okay, what's the answer? What's the answer you got, guys? ER kitna hai? ER?
0.096.
0. Very good. Well done. So 9.6%. Other people? Same answer? Easy?
Yes, sir.
Very good. So expected returns, you got it based on the formula that I explained to you. Right? Now, and obviously don't forget, beta is a important factor that affects it. Why is it more than market? Market is 9, but 9.6 QA because your beta is more than 1, right? I hope you got the connection right. Now, what is Treynor ratio, Sharp ratio? Sharp ratio is basically divided by deviation. Treynor is divided by beta, right? Answer pata. What's your answer? Risk free kitna hai? 3%, right? Right or wrong? Now you said expected return is 9.6. So you realize that I'm giving you more return than the CAPM model return. Correct? Now what's the return excess you're getting? 10 minus 3. Kitna mil raha hai? 7. Right? But jab main Treynor karunga, then I'll divide it by how much?
1.
1.1. Right? Guys, are you all with me on this? If I do Treynor, I'll do the excess divided by 1.1. Kitna aaya? What's the answer for Treynor ratio?
Have it one, you know.
What's the answer, guys? Treynor ratio. You guys can hear me, no?
0.064.
Okay, good. That's right.
So I just have a question here. For the Treynor ratio, right? Do I use 0.01 or 0.096?
Good question. Now, no. For the Treynor ratio, the ratio is actual return minus actual risk-free. So if you see a formula, it's telling you to look at the return earned, not at the expected return. What's the formula? RP. RP means actual. You cannot take 10%. You have to take 9 point. You cannot take 9 points. Usually 10%, because Treynor computes the average return earned minus the RF rate. Got it? So in both formulas, Treynor and Sharp, I will use 10 and I'll minus 3 and I'll divide it by standard deviation or beta, whichever the ratio is demanding. Clear?
Okay, sir. So we don't use the expected return, right?
No, you don't use it because expected return is the CAPM model. The expected return you'll use only in the Jensens formula, where I'm telling you that if I earn 10, I was supposed to earn 9.6. I made a Jensens alpha of 0.4%. Clear? So ER is used only in the Jensens alpha. Clear? Let's look at the answers quickly. You were supposed to earn 9.6.064, and because you earned 9.6Q per 10, you made a profit of 0.4, which is your Jensens alpha. Clear? Now, see, do realize many will always ask, what's your alpha? Alpha is nothing but exit return. Now, sharp, same funda, right? When you did your, now do remember one more thing, this is percentage. So this you won't take 20%, you'll do 0.2 and 0.19. Okay, so if I take my excess return and I divide by 0.2 and 0.19, don't forget, when you do this one, you're taking it based on Treynor, it is divided by 1.1, but here you're doing based on the deviation. You can't compare. You can't say 0.064 is very low and this is 0.35 very high. You can't compare the two because this is based on a different denominator. Okay? So here, if you notice, the market is better. The manager is better than the market when you compare the Sharpe ratio, right or wrong? Because it's giving you slightly higher return, even though there's slightly higher deviation, the ratio is better for the manager. Clear, guys? Right or wrong? Now let's come to M square. Clear that? Now M square. M square as a little formula. Okay. M square was a little twisted where you have to put the formula RF plus you find RP minus RF multiply the beta deviation. Clear? Yeah. Okay. Now here, what is the market return you're earning? 9%. Correct? And potentially, what is the M square you are making on the stock? M square. Go back to equation. Okay. M square, you have a Sharpe of 0.35. Deviation is 19%. What is the deviation of the portfolio? 20%. Market deviation is 19%, right? And what is the overall Sharpe ratio? Now, how do I arrive at the M square? Because once I get M square, I will then compare it to the market return and I get alpha. Good. Okay. Now what is M square? Potentially, it is the excess that you earned, correct? into the deviation of the market, correct? Upon the deviation of your portfolio, right or wrong? Plus, you have to add the RF. Clear? So you are supposed to earn for me 3%. Plus, you earned for me a certain excess amount, correct? Which came to how much? 10 minus 7. So 7. Into what is market deviation? 0.9. Correct? And what is standard deviation? 0.2. So if you do the maths, 0.03 plus 0.07 into 0.1 upon 0.20. If you do this, you will get M square as 9.65. You earn 9.65 M square, which is more than the market return of 9 by 0.65%. So the M square alpha is 0.65. Interesting to note that the Jensens alpha is 0.4 and M square alpha is 0.65, which means the M square alpha is actually greater, right? But remember, M square alpha is linking to market return and Jensen alpha is linking to CAPM return. Clear? So the two variables have a different game to play. Clear that? So M square is always used to find the excess return that you should have made. Clear? Are we clear the various ratios that we compute in the sum, guys? Any questions?
So
On
you said
Treynor, Sharp,
M
Jensen, and M
M
squared.
squared is for market and Jensen's alpha is CAPM, right?
Correct.
So in this case, you know, 0.4 and the other one, can we compare or not?
That's why I said that's why not directly comparable, because Jensen's alpha tries to give you the return, extra return you're earning compared to the CAPM return. But M square is trying to find out what's the extra return I'm earning compared to what the market is already giving me. Right? And remember, CAPM is adjusted for beta. Right? And M square is adjusting for standard deviation. M square looks at standard deviation, right? Do they look at beta? No. But Treynor looks, the Jensens alpha is using beta as a variable. So do you think they're comparable? No, because M square looks after standard deviation and this is taking care of beta. Okay, Sharp also looks at standard deviation. So please remember this difference in the exam. Sharp and M square go hand in hand, looking at standard deviation. Treynor and Jensens go hand in hand, both use beta as a proxy. Are they directly comparable? No. Are they approximately comparable? Maybe. But you can't compare them one to one and say, okay, the answer is so different. Okay, you can compare M square of one investment with M square of another investment. That you can do, but you can't then compare M square with Jensen's alpha. Yeah, but do remember, all of them will give consistent results. That is sure. Clear? Any question?
Just one more question.
Yeah.
So in this case, you know, we found out that M square equals to 9.65%. So what do we compare it with? Do we compare it with the market return of 9%?
For what? Sorry?
For M square. So 9.65.
See, I did not. This alpha, what is M square alpha? I compared with market return. Look here.
Okay.
Got it? So N square is nothing but the return you're getting. N square alpha is the excess return you're making over the market return. Got it? Yeah.
Okay, thanks, sir.
Welcome. Okay, and then that takes us to our last concept here, which is CML, SML. So if you remember, I told you SML is the security market line, which is entirely connected to a CAPM, where they say RF into beta plus beta, jitna beta badhega, utna tera return you'll expect. The CML, on the other hand, if you remember the efficient frontier, I told you, the efficient frontier is here. The CML is the line which is potentially tangent to the frontier line. Clear? And the line at which is tangent is the line at which is the optimal portfolio. Now, you know what they're doing? CML, SML? Simple. CML looks at total standard deviation and SML looks at only beta, which is systematic risk. So ये total risk पे ध्यान देता है, right? Or a systematic risk पे ध्यान. This is very important difference. CML, CAL, capital market line is based on the capital allocation line, and both are based on standard deviation. Capital, security market line is based on beta, because this is coming from the CAPM model. So please remember this difference importantly. Okay, obviously both have a starting point of RF and both will be going upwards, but one goes upward with regard to deviation and one goes upwards with looking at systematic risk beta. Clear? Okay, so that's an important theory that you should understand. And obviously you can use Like how I compute for you the CAPM, I can also compute for you CML. Similar way, right? What is 5% return? T-bill. So this is my risk-free rate. Correct? What is deviation? Total deviation. Expected return is nothing what they expect to make. So they're asking you, give me the points where I'm investing 0% market, 25, 75, 100. Obviously, they want to find out those points. And what is the risk and return at every point, right? Now remember, here I'm looking at 0% and risk-free rate. So if you look at risk-free rate, it normally will start somewhere here. Correct? 5%. मतलब अगर मैंने 0 भी invest किया तो मुझे 5% तो मिलेगा. If I invest more, I'll get more return, more return, more return. So my starting point is always going to be 0 in the market. No, my time will always be potentially 0 in the market and full in the risk-free return, right? Then I'll increase my market 25, 75, 50, 700, and my returns will keep going up, right? This will help me construct the CML line. Clear? Make sense? See, they won't ask you construct, but you should ask to interpret, right? 0%, like I explained to you, that means fully invest in risk-free. So my risk is 0 and my investment return is 5. I invested 25%, 75%, 100%. If I invest everything here, my risk is going to be equal to the market because I am fully invested in the market. Samjha? So my return will be equal to market return. Right or wrong? I explained to you already. And the rate and the slope at which it's going up, like this, yeah, like this, yeah, like this, is dependent on the beta. Or in this case, the standard deviation. Clear? The rate of change. Okay. How to find the slope? You can look at it by using the difference in the rates upon the. So you can find out what is the rate of change of return, right? If I change my weights, I can find out by how much is my return increasing or decreasing for every change in standard deviation. Clear? Because what is slope is nothing but the rate of change of returns. So this is how the capital market line adds up with regard to the deviation on the capital allocation line. So remember, the capital market line is not the same as a security market line. Capital market line is deviation based and security market line is beta based. But do understand, both are similar concepts. Clear? Any questions? Clear? So with that, we have now covered all about risk, return, portfolio-based deviations, right? We discussed capital sigma. We discussed more similar ratios, sharp Treynor, right? Jensens alpha, m square alpha. Please learn these carefully and revise this. Tomorrow we'll come back to you guys with similar but part 2 of portfolio management topic, which contains the other parts of our portfolio management and diversification. Okay?
So one quick question. For the capital market line, the slope is also the Sharpe ratio, right?
For the capital market line, the slope, potentially, yeah, you're right. The potential slope is a Sharpe ratio because you're looking at the rate of change of return over the risk-free return upon the rate of change of risk, and risk is 0. So you're right. Yeah. And that's why they say that in the capital market line, right, the formula is based on the slope, which is replaceable with the Sharpe ratio. So Sharpe ratio ने भी वही concept निकाला कि Sharpe ratio is the slope which indicates the rate at which your returns are changing. Correct?
Okay, sir.
Well, perfect. Chalo guys. So that note, we're done with today's class. Good questions. Please connect those dots. Very important to make sure that you are understanding the concepts. Okay, this demo is not only about solutions and questions, also about theory. Okay, perfect. Great guys. So tomorrow morning I'll meet you at 10 a.m. All the best. Study well and see you guys tomorrow. Okay, please refer to notes later and study from that carefully. Chalo. All the best, guys. Bye. Shitna, Kiran, Eddie.
Bye, sir.
Bye. Bye. Bye.